There is a particular kind of knowledge that moves through financial systems before it moves through financial media. It does not travel through press releases or analyst reports or the quarterly commentary of asset managers. It travels through price, through the silent, accumulating, irrefutable language of markets that know something the public has not yet been told. Gold knows first. Oil knows first. The currencies of commodity exporting nations know first. The sovereign reserve portfolios of central banks that manage capital across generations rather than quarters know first. The public knows last. The public always knows last. And between the moment that price begins to speak and the moment that the public finally listens, there is a window, a specific, historically measurable, finite window, in which the knowledge gap between the informed and the uninformed translates directly into a positioning gap that will define the financial outcomes of everyone on both sides of it for the decade ahead. That window is open right now, and the message being transmitted through it clearly and consistently and with a persistence that admits no ambiguous interpretation is this: dollar devaluation has already begun. Not as a forecast, not as a scenario, not as a risk to be hedged against some future contingency. As a process, structural, sovereign-driven, multi-year in its momentum and still in its early enough stages that the positioning opportunity exists, but late enough that the direction is no longer a matter of analytical debate among the institutions whose judgment and whose time horizon and whose access to information make them the most reliable readers of these transitions. In the next 25 minutes, I am going to give you 3 things that will permanently change the way you read the relationship between the dollar, gold, oil, and the sovereign decisions that are driving all 3. First, what dollar devaluation actually means. Not the headline definition, not the simplified version, but the structural mechanism through which a reserve currency loses purchasing power in ways that are invisible to most conventional measurements until the damage is already done. Second, why gold and oil are the first movers in this process. The precise institutional reason these 2 assets register devaluation before it appears in any inflation report, any exchange rate index, any Federal Reserve communication, and why that sequencing is not coincidental, but structural. Third, what the historical record shows about the trajectory of a devaluation once it has begun at the structural level, how long it runs, what it does to the assets on either side of the process, and what the markers are that distinguish the early stage, where we are now, from the middle and late stages, where the opportunity has substantially closed. I have spent a career studying these devaluation cycles across multiple reserve currencies, multiple centuries, and multiple iterations of the same underlying dynamic. The details differ each time. The mechanism does not. And the mechanism is currently operating with a clarity and a scale that I have not seen in my professional lifetime outside of the historical case studies I have spent decades analyzing. The conventional definition of dollar devaluation is a decline in the dollar's exchange rate against other major currencies. The DXY index falls. The euro buys more dollars than it did before. The yen strengthens. This is the definition that appears in financial media that gets tracked in real time on trading screens, and that most investors use as their primary indicator of dollar strength or weakness. That definition is inadequate, not wrong. It captures something real, but inadequate for understanding the deeper form of devaluation that is currently underway, because the deeper form is not primarily a relative currency story. It is an absolute monetary story. And the distinction between those 2 frames is the most important analytical point I will make in this session. Relative devaluation, the dollar falling against the euro or the yen or the yuan, is a statement about the relative monetary policies and economic conditions of the issuing nations. It is measured against other fiat currencies that are themselves subject to the same structural pressures, the same debt accumulation dynamics, the same central bank credibility challenges that afflict the dollar. A dollar that is falling against the euro is not necessarily a dollar that is losing its fundamental monetary value. It may simply be losing less quickly in one direction than another. Absolute devaluation, the devaluation that gold measures, is something categorically different. It is the loss of the dollar's purchasing power relative to assets that exist outside the fiat monetary system entirely. It is the measurement of what a dollar buys not in other currencies, but in things, in energy, in metals, in the real productive capacity of the physical economy that paper currencies are supposed to represent and facilitate, but which they do not themselves constitute. Here is what matters. The dollar has been experiencing absolute devaluation, as measured by gold and oil and other real assets, at a pace and with a persistence that does not show up in the DXY index, because the DXY index is measuring the dollar against other currencies that are depreciating by similar mechanisms for similar structural reasons. Let me be precise. Gold priced in dollars has increased by more than 500% over the past 25 years. Oil, even accounting for cyclical volatility, has increased by several 100% from its pre-2000 baseline. Agricultural commodities, industrial metals, real estate, productive farmland, the assets that represent claims on real economic output rather than on institutional promises, have all experienced sustained dollar-denominated price appreciation that substantially exceeds the official inflation measures designed to track it. This is the first and most important signature of structural dollar devaluation, the progressive increase in the dollar price of things that have not themselves changed, that are not experiencing supply constraints that would independently drive their prices higher, and whose price increases are therefore accurately interpreted as the reflection of a diminishing dollar rather than an appreciating commodity. Write this down. When gold rises and the conventional framing is that gold is going up, the more accurate framing, the one that the buyers at the sovereign level are operating from, is that dollars are going down, measured in gold. The asset has not changed. The currency measuring it is changing. The price movement is the signal, and the signal is directional, persistent, and structural in its origins. The mechanism driving the structural devaluation is the one I have described throughout this series. The accumulated consequence of fiscal expansion that has outpaced the productive capacity it was supposed to support, monetary accommodation that has expanded the supply of dollars faster than the supply of the real goods and services those dollars claim, and the progressive erosion of the institutional trust that gives a fiat currency the credibility to serve as a stable store of value over time. The devaluation does not require a collapse. It does not require a dramatic event. It requires only the continuation of the conditions that have already been established. The fiscal deficit, the debt accumulation, the structural decline in petrodollar recycling that suppressed American borrowing costs, the Federal Reserve's constrained ability to tighten without creating financial instability. These conditions are in place. They are measurable, they are directional, and they are producing their predictable output, a dollar that buys less of everything real, quarter by quarter, year by year, in a process that is already underway and that has no political mechanism currently available to reverse it. Now let us turn to the sequencing question, because why gold and oil know first is not merely an interesting observation. It is a precise institutional mechanism that explains the positioning window we are currently inside and why that window closes the way it does. Gold and oil are the first movers in dollar devaluation for a reason that is simultaneously simple at the surface level and profound at the institutional level. They are priced globally in real time by the most informed participants in the financial system. Participants whose decisions incorporate information about sovereign reserve policy, about geopolitical energy flows, about central bank strategy, and about long-cycle monetary dynamics that the broader market processes months or years later, if at all. The gold market is dominated in terms of structural price direction, not by retail investors or even by institutional funds in the conventional sense. It is dominated by central banks, sovereign wealth funds, and the large bullion banks that intermediate for those sovereign actors. These institutions do not buy gold because a technical chart looks attractive. They buy gold because their structural analysis of the monetary system, conducted with resources, information access, and time horizons that are categorically superior to anything available to retail participants, tells them that the conditions for sustained dollar devaluation are in place. and that gold is the appropriate reserve instrument for navigating that devaluation. The oil market, similarly, is dominated at the structural level by sovereign producers and sovereign consumers, whose energy trade decisions incorporate geopolitical intelligence, long-cycle demand projections, and currency strategy assessments that go far beyond what any single market participant can access independently. When OPEC Plus makes a production decision, it is making a decision that incorporates assessments of dollar purchasing power, of the trajectory of dollar-denominated energy revenues, and of the geopolitical architecture of energy trade that implicitly reflects a sophisticated view of where the dollar system is headed. Here is the part most people miss. The sequencing, gold and oil moving before the public understands why, is not accidental. It is the direct result of the information asymmetry between the institutions that drive those markets and the public that eventually reacts to them. The information asymmetry is not created by secrecy, exactly. It is created by the difference in analytical framework, time horizon, and institutional mandate between sovereign buyers and retail investors. A central bank buying gold at $3,000 per ounce is not making a statement about where gold will be in 3 months. It is making a statement about where the monetary system will be in 3 years, in 5 years, in 10 years. The 3-month price is noise and a signal it is measuring on a decade-long frequency. The retail investor who looks at the same $3,000 price and asks whether it is too high to buy is asking the wrong question. Or rather, asking the right question on the wrong timescale. The oil market's first mover quality operates through a different but equally precise mechanism. As the petrodollar recycling loop weakens, as more oil is settled in non-dollar currencies, as more oil revenue flows into non-dollar reserve assets, as the structural demand for dollars that oil pricing creates begins to erode at the margin, the dollar price of oil must rise to compensate oil producers for the declining purchasing power of the currency in which their revenues are denominated. This is not a supply and demand story in the conventional sense. It is a monetary story expressed through the commodity market, the oil price absorbing the dollar's devaluation in real time before that devaluation is fully reflected in official inflation measures or exchange rate indices. Let me be precise about the current configuration. Gold rising through successive all-time highs, driven by sustained sovereign buying at elevated prices, with a buyer profile that does not reverse at quarterly fluctuations. This is the classic first-mover signature of structural dollar devaluation being registered by the most informed market participants before the broader public has incorporated that information. Oil maintaining a structurally elevated baseline price despite the United States becoming the world's largest producer, a development that in a purely supply-demand framework should suppress prices, reflects the same monetary mechanism operating through the energy market. The dollar cost of extracting, financing, and marketing oil is rising in nominal terms because the dollar itself is purchasing less real economic capacity than it did in prior cycles. This is the configuration that historically precedes the moment when the devaluation becomes visible and undeniable to the broad market. It is not the configuration that follows that moment. We are before it, not after it. The first movers have already spoken. The public has not yet fully heard. If you are recognizing in this analysis a framework that has been missing from your financial thinking, a structure that connects the dollar's condition, gold's behavior, oil's pricing, and sovereign institutional decisions into a coherent and actionable picture, and signed for so subscribe now. We build this framework systematically, and the analysis continues to deepen with each session. Now let us turn to the historical record, because the record of prior structural dollar devaluations, and there have been several identifiable episodes in the post-Bretton Woods era, gives us the most reliable map available for understanding where we are in the current one. The most instructive precedent is the devaluation that ran through the 1970s. I return to this precedent not because the conditions are identical, they are not, but because the structural mechanism was the same, and the sequencing of asset behavior was the same, and the lessons for investors who understood versus investors who did not understand what was happening are the most clearly documented of any prior episode. In the early 1970s, the conditions for dollar devaluation were in place in a form that was visible to the most sophisticated institutional observers, but not yet to the public. The United States was running fiscal deficits to finance the Vietnam War and the Great Society programs simultaneously. The Federal Reserve had accommodated that fiscal expansion with monetary policy that was insufficiently restrictive. The gold window had been closed in 1971, removing the external constraint on dollar creation. And the oil shock of 1973, engineered by OPEC in response to American support for Israel in the Yom Kippur War, transformed a latent inflationary condition into a visible crisis. Gold knew before the public. From 1970 to the closing of the gold window in 1971, gold was still fixed at $35 per ounce by official policy. But the shadow market, the market in which gold was traded outside the official price, was already pricing the devaluation that official policy was suppressing. Within months of Nixon's announcement, gold moved to reflect what the shadow market had already known. Within years, it reflected what the full structural devaluation of the 1970s implied. By 1980, gold had gone from $35 to over $800. That is not a story about gold becoming more valuable. That is a story about the dollar purchasing 23 times less gold at the end of the decade than at its beginning. The gold price was the measuring instrument. The dollar devaluation was the thing being measured. Oil knew before the public as well. The 1973 oil shock was precipitated by a geopolitical event. But the structural vulnerability that made it so devastating, the American economy's deep dependence on imported energy, priced in a currency that was being devalued, was already in place and already understood by the producers who held the leverage. OPEC's pricing decisions in the 1970s incorporated a sophisticated understanding of dollar devaluation dynamics that the American public was not given the analytical framework to process until years of inflation had made the reality undeniable. Now consider the current configuration against that historical precedent. The fiscal conditions are more severe today than they were in 1970. The debt-to-GDP ratio is substantially higher. The interest cost burden is larger as a percentage of federal revenue. The Federal Reserve's balance sheet is more extended. The structural demand for dollars, maintained in the 1970s by the petrodollar arrangement that was just then being established, is today being eroded by the same geopolitical dynamics that created it 50 years ago, operating in reverse. The gold price is already registering the devaluation. It has been registering it for years. The sovereign buyers driving that registration are operating with the same institutional logic that drove the equivalent buyers in prior episodes. The logic of a monetary system whose structural supports are weakening, whose fiscal arithmetic is unsustainable without either inflation or default, and whose reserve currency function is being progressively challenged by the emergence of alternatives at the sovereign level. The difference between the 1970s devaluation and the current one is scale, not structure. The scale of the debt, the scale of the institutional commitments, the scale of the global monetary system that the dollar anchors, all of these are larger by an order of magnitude, which means the devaluation, when it is fully expressed in the price of real assets, will be larger by an equivalent order of magnitude. Let me be precise about the trajectory. The historical record of structural dollar devaluations shows a consistent pattern. A first phase in which the informed institutions position, quietly, persistently, without public acknowledgement, over a period of years. A second phase in which the devaluation becomes visible in the prices of real assets and commodity importing economies begin to feel the consequences in living standards and import costs. And a third phase in which the broad market acknowledges the reality, the consensus updates its framework, and the price of the assets that captured the devaluation reflects the full weight of public recognition. We are in the first phase. The first phase has been underway for several years. Its duration in prior cycles has ranged from 5 to 15 years before the transition to the second phase becomes undeniable. The second phase, when it arrives, is not an opportunity for the uninformed to catch up. It is when the cost of not having understood the first phase becomes visible in portfolio returns. Let us now bring the three threads together into the synthesis that gives you the most complete picture available of what is actually happening in the monetary system right now. Dollar devaluation has begun, not as a headline, not as a prediction, but as a structural process that is already operating, already visible in the instruments that register it first, and already reflected in the reserve portfolio decisions of the sovereign institutions whose analytical and informational advantages make them the most reliable early indicators of where long-cycle monetary forces are pointing. Gold and oil know first because the markets in which they are priced are dominated at the structural level by participants, central banks, sovereign wealth funds, major producers, whose time horizons, information access, and institutional mandates make them the first processors of the devaluation signal. Their buying behavior is not reactive to the devaluation becoming obvious. It is anticipatory of the devaluation becoming complete. And the sustained, structurally driven, price-insensitive nature of that buying is the clearest possible signal that the devaluation they are pricing is not a quarterly fluctuation, but a multi-year directional force. The historical record of prior devaluations at the structural level tells us that the first phase, in which informed institutions position and the public remains largely unaware, is followed by a second phase of much more compressed price movement in which the reality becomes undeniable. The investors who captured the full value of prior transitions were those who were positioned before that compression. The investors who waited for the compression to confirm their analysis were positioned after most of the structural repricing had already occurred. What unites all three threads is the information asymmetry, the gap between what gold and oil and the sovereign buyers behind them have already registered and what the broad market has not yet incorporated into its positioning. That asymmetry is not permanent. It is finite. It closes as the devaluation progresses from the first phase to the second, as the price of real assets in dollar terms becomes too conspicuous to explain away with any framework that does not acknowledge the monetary reality underneath. The window is defined by the gap. It is measured not in the price of gold, not in whether gold is at 2,000 or 3,000 or 4,000, but in the proportion of the total structural repricing that has already been expressed versus the proportion that remains ahead. Based on the historical precedent, based on the current fiscal arithmetic, based on the documented momentum of the sovereign buying that is the most reliable institutional signal in this cycle, a substantial proportion of the repricing remains ahead. Gold and oil do not lie. They do not have narratives to maintain. They do not have institutional relationships to protect. They do not have quarterly earnings calls on which they must present an optimistic outlook to satisfy consensus expectations. They have only price. And price is the distillation of the most informed judgment available in the market about the most fundamental question any monetary system must answer over time. Does the currency in which all other values are denominated actually hold its value? The dollar's answer to that question, measured not in official statistics, not in the language of Federal Reserve press conferences, not in the confident projections of Treasury Department analysts, but in the price of the oldest monetary asset in human history, and in the price of the foundational energy commodity that powers the global industrial economy. That answer is already being given. Gold and oil are giving it every single day. They have been giving it for years. The devaluation they are measuring is not a future possibility. It is a present reality, already in progress, already registered by the most sophisticated institutional participants in the global financial system, and not yet fully incorporated into the positioning of the public that will eventually learn what gold and oil already know. The question was never whether dollar devaluation would begin. The structural conditions that produce it have been in place for years. The question is what you do with the knowledge that it already has, and how much of the remaining repricing you intend to capture before the public arrives at the same understanding that the most informed institutions in the world reached years before the conversation became this public. Gold and oil knew first. That knowledge is now yours. What you do with it is the only question that remains.